I recently got a comment saying, the banks in Wall Street are buying them all up. We have no chance. How is the regular American supposed to get a home? Has housing gotten out of hand? Are the banks gonna win it all? How do we beat the investors and banks and buy a home of our own? We need a plan. We need a good plan. We need something deeper than just saving for a down payment.
We need a plan. I need to write a plan. Get started on that. Good afternoon and welcome. We're going to be walking through how to buy a home in America by the year 2030. Now, to walk through all of the needed details that we have to go through, it's going to take some conversating between you and I. So I do want to let you know ahead of time, this could be a longer form video because we're going to be walking through the main qualifiers to being able to qualify for a home. We're going to walk through the truths. I'm going to be very honest with you about the state of today's market in 2025 as we walk into summer, the progress, how we get to the goals I'm going to set for you. And then at the end, I'm going to give you the payoff. And that's going to be the best possible home that you could buy, the best possible mortgage program that you can get into, and the best location. Couple radical thoughts we'll throw in. One of them is going to be around maybe relocating. We'll get to that. But the promise I want to set for you is, although this is a difficult market, although it's historically the most unaffordable housing market to ever potentially buy a home in these last couple of years, there is still a route to follow. There is still a path that can be trekked. And I want to walk through this as if you're a client, walking through the exact steps you should take, give you a firm expectation, and then a plan. So without further ado, let's walk through this blueprint on how to buy a home by 2030. For starters, let's go through the four main qualifiers. To remember them, I'm going to tell you desk with a C. So it's a debt to income, employment, savings, credit score. Now, the minimums for these are all different. We'll walk through them. Let's start with credit score. Credit score, you're going to get told different numbers. I'm going to tell you 640. The reason I tell you 640 is because some people are going to tell you 620. I think that's too close to the line. And then others will tell you, oh, on an FHA loan, you only need a 560, 580. That's half true, half not. You're going to get a really bad interest rate and less favorable terms if you don't have a higher score. I will go into later too, the best mortgage program that you can get requires a 680. Baseline is the better your score, the better chances of financing you get. The better chance you get at a low rate, the better chance you not have a big down payment. Keep your credit high, but get it above 640. Also, don't use apps like Credit Karma. Use apps like Experian and TransUnion. Go straight to the source. Reason being, because Credit Karma and all these other apps, they have one goal. They want you to download their app and use their app. And it's an algorithm. It utilizes public data. It's not your actual credit score. It's what Credit Karma thinks is your credit score. So I highly advise going straight to the source. Let's move on to savings. Savings, 5% of what you're looking to buy. Let me break that down. If you're looking at buying a $300,000 home, which is largely accomplishable in most areas of the country when you get away from the West Coast and the Northeast, we'll go through the most affordable areas in a minute, is you're gonna need 15 grand to accomplish that. That's 5%. And a lot of people will tune out immediately saying, I don't think I can save that much. And if that's true, maybe. I don't know, but it is required. I do have a couple down payment options we'll walk through, but savings-wise, get to 5%. I had this friend of mine when I was in high school, quick story, who had 2 grand in his bank account. 2 grand. And he was only making 3 grand a month. And between him only making 3 grand a month before taxes and having 2 grand in the bank account, I think it was actually like 1960 when he sent me the screenshot, we got him a house. $1,000 payment, acre of land in Houston, Delaware. Spells just like Houston, but it's Houston in Delaware. We're not allowed to say Houston. Real story. Today, can't happen. Let's get on to employment. There's a lot of misnomers about employment, a lot of old wives' tales. Oh, you gotta be at your job for 2 years. Oh, you just switched jobs. You can't get a mortgage. Not true. If you've been at 8 jobs in the last 2 years, so long as you've been, quote unquote, if you're taking notes, progressing in your career is what the guidelines will look at, and as well as if you're also staying in the same niche. So let's say you're a teacher and you're making teacher money at a school, and then the bank sees that, well, you weren't unemployed, but you went straight from being a teacher to working at Target. They're gonna have questions because ultimately you're signing up for a 30-year loan. They wanna see you're consistently making money, okay? I wanna look at my list, yes. Debt to income. This is what's going to disqualify the most people. And you yourself may be thinking, what's debt to income? What's verifiable income? What's a verified debt? What is the bank looking for? Let's walk through it. The key rule of thumb with debt to income is the less debt, the better. And the more income, the better. I know that's a very biased, privileged statement to make, but that's the harsh truth of it. The less debt, and when we say debt, you may be saying, what counts as debt to a bank? Is my plumbing bill, my water bill, is my DoorDash addiction, is that debt? And no, it's not. It may be depleting your savings, but it's not considered debt. Debt is anything that usually is tied to your Social Security number. This is a car payment, credit card payment, student loans, things that you're contractually obligated to pay, or else they're going to alter your credit score. If you didn't pay your water bill, they're just going to shut off your water. It doesn't necessarily factor into your debt to income, if that makes sense. On the income side, verified income has to come from a job, could be an independent contractor, but if you're working on your own, you got to make it consistently. Again, you're signing up for a long-term loan. So on the income side of things, you can't just go on OnlyFans. You can't just go to DoorDash and Uber and side hustle yourself to death for 6 to 8 months. The bank does not care. I repeat, the bank does not care about how much money you're making inconsistently. If you're an independent contractor working as an entrepreneur, you're in sales, you're in insurance, they're going to look for your last 2-year average. So this last year and the year before, what did you make in both of them? And then they're gonna take the average. If you're working on your own as opposed to a normal job, you will need to be doing that for at least 2 years. If you're working at a job, W-2, you could flip jobs all the time as long as, again, you're staying in the same niche and making more money. So we need to have verified income and as little verified debt as possible. But let me tell you this. Today, if you were to go to buy a home, it's probably no secret, you're more than likely going to have, and I'll mention this in the truth section we're about to walk through, a higher mortgage payment than you'd like. Let's say it's $2,500, and you may say, Zach, that's egregious. It's realistic. It's actually the median mortgage. It's lower than the median mortgage in the entire country. If it's $2,500 and you need to make a third, your housing payment of the 2/3 of your making of income, in English, what I'm saying is, if you were to make $7,500, you'd be able to afford a $2,500 mortgage, because that is a third of what you make in total. Does that make sense? From there, we can see the debt to income ratio and how it's changed over the years. Going back to my friend from high school, when he bought his home, he made $3,000 a month. We were able to get him $1,000 mortgage. $1,000 was a third of his $3,000 income, so we could do it. The bank approved it. But today, if you were to walk into maybe even a similar home that's only $2,350 to $2,500, again, you're going to make over $7,000. That's what you're going to have to make to qualify for that home. So debt to income is pivotal. The more debt you have, the less take-home money you have, the less the bank will trust you with on a pre-approval. And we all know homes are more expensive than they were back when my high school buddy got his house, and you're going to end up with a higher mortgage. Last thing I'll hit before we go into the truths and the progress, you cannot combine credit and income with your spouse. To be clear on that, if you have the great credit score, but you don't have a lot of income, and your wife makes a lot of income, but doesn't have a great credit score, you can't flip-flop. You can't say, well, can we use my credit and her income, or vice versa? Nope. You gotta have that minimum credit score. 620 is minimum for most programs. 640 is what I want, and 680 is optimal plus, but you gotta at least qualify credit-wise for the income to count. Okay, so that's our 4 main qualifiers. Remember, DESC with a C. Now, let's walk through the truth, the progress, and the payoff. We're gonna start with the truths about today's housing market, what I believe you need to have in the bank, what I believe you need to make per year, what I believe your credit score needs to be, and what I believe you need to have saved, as well as I'm gonna give you some progress trackers, some ways to hit those goals before getting to, at the end, best home, best mortgage, best location, okay? So starting with the truths, we have 4 of them, and they're based off of the minimums we just talked about in DESC. We need to have 4 minimums hit, 4 goals obtained to feel comfortable in today's housing market. And I say comfortable loosely because there's a lot of people that won't be comfortable with any payment that they can obtain today. I mean, there's a lot of people that are still hoping for 3%, 4% rates. I don't think those are coming back. There's a lot of people hoping for lower home prices. I am too. We have our housing affordability tracker. You can click right here. We are tracking, will housing become more affordable again? And I'm on the side of believing it probably won't be. I believe personally that, and I hate saying this out loud, and you may say, Zach, you can say in the comments, I hate that, I don't think it's true, housing is gonna crash, it's all gonna implode. I think there's a better chance that home prices double than crash. Just being honest. Analytically speaking, mathematically speaking, we don't have enough supply, we don't have enough affordable homes, probably gonna keep going up. Which means there's no better time than the present to start soaking in how to buy a home by 2030. Let's get into the truths. That wasn't the truth, it was, but there's more truth. So let's start with how much money you should make. I believe you should make $100,000 a year. $100K a year is actually below what the Wall Street Journal reports as the median income needed to buy a home in America. They reported $126K. I've seen people walk into our office, talk with mortgage lenders that make 110, 120, and due to some debt and the current scenarios in today's market, could not afford a home. I want you to at least make 100K. That does mean your household, so that means 50K, 50K, and that's also for taxes. Just to be clear, that's gross income to your home should be 100K to feel comfortable in today's market. Now, you may be saying, Zach, I'm from Mississippi. I don't need to make that much. You're absolutely right. Mississippi, Tennessee, West Virginia, Arkansas, Alabama, 100%. You're maybe 45 minutes from society, but it's possible. Now, when you're in areas that kind of fit in the middle ground, where you're looking at Delaware, Nebraska, you're getting into Nevada, you look at Florida even, that's kind of has an iffy market, but you get into areas that fall more in the middle ground, and a 300 to 325K home is pretty normal, and that's what I'm planning you for, just to be clear. Second truth, no more than a third. We referenced this earlier. Your mortgage payment should never be more than a third of your take home. And I say take home in that way specifically. Let me break this down. I just said you need to make 100K gross. If you don't know what gross means, it means the money before the gross government comes and takes its taxes. It's the money you have in total before they come and take from you. Net is what you have after the government is done thrifting your money away from you. That's your take home money. That's the money I'm talking about right here. I want to see that your mortgage payment is 1/3 or less of your take-home pay. Why? Because I don't want you house poor. I'm a real estate agent, but I quite honestly don't want you hitting me up a year and a half after you bought your home to say, Zach, we have to sell. Why? We can't afford it. I don't want that call. I don't want to hear your credit got ruined, your car got repoed, your kid got switched out of schools because you can't afford your mortgage. I'm all for homeownership, but I'm also for fiscal responsibility. And that may be living with family. I love that. Living with friends. I love that. Homie hack. We'll touch on that later. So no more than a third. Third truth, credit over 680. Already mentioned this once. Gonna break it down one more time. Why 680? Because when we're talking about VA loans, USDA loans, FHA loans, even jumbo, conventional, you get better rates with higher credit. I also want you to have access to all these programs. We're gonna talk about later state authorities and how to get the best mortgage. You're gonna need a higher credit score to qualify for some of these state programs. I'm being real with you. There's a lot of people, especially lenders, 560, we can work with it. 480, we'll figure it out. 610, yeah. They just want to get you on the phone. They want to write mortgages. I'm just being honest. I'm telling you right now, it's now is the time. We're 5-year planning. Get your credit up, get your money up, okay? Get your credit up, get your money up. We'll talk about strategies to do that here in a moment. We're setting the truths in stone. Fourth truth, then we'll get to the progress. I want you to have 5% saved. We mentioned it earlier. Want to have 5% saved. If you're looking in your area and you're seeing homes that are doable, we're not talking about forever homes. We're talking about starter homes. We know there's not a lot of them. I'm going to talk about some that I think fit the bill best, but look in your area. What realistically could you pay to get a home? Okay, find the price, 5%, write it on your mirror. That's what you need in the bank account. That's what needs to be in the IRA. That's what needs to be in the Robinhood account, because that's what you're gonna need to show the bank to say, hey, I have money.
How much money you make?
I don't know, 70,000 last month.
I've proven that I can save it, and I want to get a mortgage. It's called reserves in the bank world when you're getting a mortgage. They want to see you have reserve. All right? 4 truths. 100K, no more than a 30-year mortgage, 680 credit score, 5% in the account. How do we progress toward those goals? Let's break that down. So to progress toward these goals, I really only see 4 items that are needed. We need to increase income. We need to increase credit. We need to cut debt, and we need to stock away money. Let's walk through those. If you want to increase your income, you may hear me say that and think, easy for you to say, real estate boy. But it's honest. You have to find a way to make more verifiable money. If you don't make 80K minimum, and I said 100K, but 80K minimum, 75K maybe, if you got like no debt, you got no chance. Let's let the silence hit for a second. No chance. None. You have to make enough for the bank to qualify for you for the mortgage, okay? So increasing income has to be done in a verified form. It could be more hours at your job. It could be a better position at your job. It could be the spouse taking up a job as well to increase the household income. It could even be, and this is one of the radical thoughts, I have 3 radical thoughts written down, this is one of them, could be analyzing your career path and deciding, is this the job you want in 5 years? Is your career path, are the stones in the pond ready for you to follow, set up for you to eventually even come close to making 100K? If it's not, maybe we start thinking about what genre of job we're in. our job field. Okay, let's walk through increased credit. This is a simple one in my opinion. You need to get with a mortgage company. Most all of them have mortgage repair programs that are absolutely free. Free 99, no dollars to your name because they want to write you a mortgage. Go figure, the salespeople who sell mortgages want to get you prepared so they can sell you a mortgage. Go do a credit card repair. Oh my gosh. Go to a credit score repair company through a mortgage lender, specifically a local one. Like I'll shout out White Cap Mortgage in Delaware. They're local. They know the local legalities. They know the local bonuses. They know the local incentives, as well as they can help prepare you for that specific mortgage you need. That's enough on that. Increase your credit, get it to 680 as a goal, 620 minimum, 640, the real minimum in my opinion. Stock up. We need to stock up and we need to cut debt. That's 3 and 4, but they run in tandem. I want to tell you, I have not always been the best saver. I think all of us have gone through a period in our life where we hit a little bit more money than we've ever had. If we've ever been blessed to make a little bit more than you had in the past, to think, oh man, I have some money to spend. I'm gonna go into some debt, nice. And I did that. I got home from my deployment. It was 2014, did a year-long tour to Afghanistan. And after that, next 2-3 years, the debt rung up. I started a business.
Welcome to 144 Plain Dealing Road. This is a 5-bed, 3.5 bath. Welcome to episode 1 of Loft Talk. And today,
I got into real estate and all these things combined, I was $86,000 in debt. Our net worth, my wife and I were negative $100,000. It wasn't good, but I heard one person say to treat your life as an investment, not a consumption. And it shifted my brain. Now I'm very woo-woo, we do the whole meditation thing. And at the time I was, waking up early in the morning. It was calm, I was tired, I didn't want to be up, and I was doing some little meditation mantras like, I'm an investor, not a consumer. I'm an investor, not a consumer. And eventually my brain got to the point of when I went to go make a consumption, let's say buy a sandwich for $5, my brain would say, is this an investment or a consumption? And my brain would say, well, this is a consumption. Okay, so what I would do is I would take the $5 I was ready to consume into the economy. Catch this part. I was ready to take the money that I could consume and I invested it instead. I put it in a Robinhood account. Be an investor, not a consumer. Invest in your future, don't consume, okay? It can happen very little by little, both in the consuming it side, before you know it, you're in a ton of debt like I was, or before you know it, you have a stockpile set aside that you could actually invest in a real estate property. All you had to do was stop ordering DoorDash so much. Maybe that's only a small part of it, but you get what I'm saying. So I want you to cut the debt. That's the biggest thing that you can do. And as you start stockpiling more money, you can get rid of the debt. That's gonna up your credit score. It's gonna release your debt to income. And it's going to allow you to get pre-approved not only for more, but you're gonna be able to afford more comfortably. Your take home will be higher. You're not gonna be awake at night thinking, oh my gosh, I have 30 grand in debt. Instead, you're gonna think, man, I'm in the positive net worth. I'm setting myself up to buy a home in 2030, which is exactly why we're here. Now, with the minimums we know to get into our first mortgage, understanding the truths of buying a home today and in the future, and of course I am, when talking about the future, 2030, I don't think home prices crash. I think they only go up. We keep printing money as a government, quantitative easing. We continue to have a debt problem. We continue to eye down different policies that might involve big tax cuts. This usually marches right alongside with inflation of assets. Assets like homes keep going up. They went up 47% since 2020. It's obnoxious. I'm not saying that happens again, but going up 2 to 5% a year for the next 5 years is completely possible and normal. Could be more, could be less. But think about 2 to 5% for 5 years. That's a large increase, little by little by little. So we want to be ahead of it. And I want to start that by telling you the best mortgage program that you can go after, the best possible type of home and way of getting it. It's going to surprise you. I promise you, you're going to be like, oh, he's going to say a tiny home. I'm not, because they don't exist and they're hardly mortgageable. And I'm going to tell you the best location. And that's one of the radical thoughts too. I mentioned another radical thought earlier about your career. I'm going to mention another radical thought about location. All right, so let's get into it. The best mortgage program that you can get, and I'll put a little asterisk next to this, put a little asterisk, if you have not served in our country's military, is going to be an FHA state authority loan. What does that mean? It is going to be a federal housing authority loan, which is a government loan from our federal government that only requires you to have a 3.5% down payment. This is also where you'll hear lenders talk about, oh, you only need a 560, 580. Yes, because technically FHA underwriting and approval is a lot of storytelling. It's, oh, they make this, they have this in savings, and they have this backup, so their credit, it doesn't really matter. You can convince the government. I don't want you to have to convince anybody. I just want you to get qualified. I just want you to get a good interest rate because, again, worse terms when you do that. Better terms when you're 620 and above. Specifically, though, because you've probably heard of FHA before, I also want you to double down. I want you to double dip the chip between federal funding and state funding. Your state, I'll speak to Delaware specifically, the Delaware State Housing Authority, DSHA, can give you a lower interest rate on that FHA loan. Or, and I don't always suggest this, it's a little bit of like the carrot on the stick. You think it's a good deal and then it ends up being a bad one, but they can also give you money. They can also give you money. It's normally never in a forgivable, if I could talk, grant. It's usually always in the form of what's called a secondary zero interest lien. English words, you have to pay it back. So if it's forgivable, if it's a grant, awesome. Look up your state's housing authority, see what they're offering. That could have been bad. But in reality, they're probably going to give you one of the two. I would always take the lower interest rate mixed with the FHA loan. You're going to have the best possible down payment. Now, I did say that asterisk. If you have served in our country's military, first of all, thank you very much. I served in the military as well, did the whole tour of Afghanistan, got my VA certificate, and I was able to use a VA home loan to get my first home and the home we're sitting in right now. This is a basement. Isn't that crazy? So the VA loan is the best option. 0% down, no PMI. You don't have to pay as much of a VA funding fee your first time. It's very low. And at the very same time, you're going to get the best interest rate on the market. And let me tell you about that double dipped chip. You can still use your state's money or interest rate. Crazy. So whatever rate you could normally get for serving our country, you can get an even better one potentially by going to your state's housing authority as well. Now, the difference between FHA, VA, and your state housing authority, if you've already bought a home in the past, you're not going to qualify for this over here. Okay? FHA is largely seen as first-time homebuyer program. It's technically not. You can use as many times as you'd like. VA, you can use as many times as you'd like. It's an old wives' tale. Over here, have to be a first-time homebuyer, just to be clear. But that's going to be your best mortgage program. FHA with state authority. Now, what's the best home that you can get with that mortgage? That's the next question we got to answer. And in my opinion, there's nothing close to the option I'm about to give you. Now, it does come with a major con that I am going to address. I'm not going to leave you blind. But in my opinion, in a world where home prices don't get down, in a world where this type of home is always built in a growing market normally, and you're getting a product from the builder that can be built at scale with affordability in mind. A lot of gibberish to say a new construction townhome is probably your best bet. Now, why? I know you don't want to share walls. I know you want to have your own property. I know you want to have a lot of land for your dog to run around and be a dog. I get it. But in a world where home prices are going up, I want you to get in on the real estate game. Now, why do I say townhome and why do I say new construction? Well, I say townhome because that is the best way to get a low square foot affordable option from a new construction builder. A lot of affordable homes aren't hitting the market, hear me, because people don't want to sell them. They have an $850 mortgage. Tina, answer me this. Why would they sell that? Did you know 39.6% of homes in America don't even have a mortgage? Why would they sell that? They make for great rentals. They make for getting your kids involved in real estate when you got 5 properties and you can gift one off to your kin when they get out of college. Like, that's a great game plan for those that have multiple properties. Why would they sell that? They're not. And so new construction is now in the limelight because they have the opportunity to fulfill the market. They're not really filling it with affordable housing, but the one place they are doing it a little bit is with townhomes. Now, why do I say new construction? I specifically say new construction because I want you to pay as little down as possible and have the best mortgage rate available. We just said FHA with state authority is the best mortgage. But if you get that through a lender at the new construction, ding, 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 we're hitting all the bells to get the best deal because new construction's starting to sit. K. Hovnanian, Ryan Homes, D.R. Horton, all these other companies, they're starting to see their homes sit a little bit. And there's a lot of factors to go into that, and it may not be a prolonged thing. I believe it may, but they're starting to get better incentives. They're starting to get better deals. And a lot of these national builders sometimes have regional problems that will leak into their national programs. What do I mean by that? They're not selling as many homes. So what do? They make programs. They get better rates from their investors to give better mortgages, to sell more homes in Florida. But being a national company, it bleeds over into the other states too. So these national builders, and I will mention the con, you may see it coming, the big pro is you can get a low rate. They can sometimes cover your closing costs and your down payment. One story about that, we just recently worked with Lennar Homes, Lennar, and they had a deal where we were able to get a 3.99 rate, wild, that went to 4.99 the next year, and then it stopped, so it didn't adjust past then. It was like a structured adjustable. And they were offering $10,000 in down payment assistance. You know what we did? We asked for another 20 to cover more than their down payment and their closing costs, and without any negotiation, yeah, sure. 30 grand, low mortgage payment, got started in real estate with a $285,000 townhome. I also love townhomes because they're normally built around growing and flowing markets. You don't see townhomes in the middle of Oklahoma. You don't see townhomes in markets that aren't already supplying good value to the people living there. Townhomes are built when they need supply, especially affordable supply. So FHA, State Housing Authority, new construction, townhome. Where do you need to go though? We're going to throw up a screen grab real quick of our housing affordability tracker because specifically we're tracking the National Association of Realtors Affordability Index. And what I love about this affordability index is they take the median family's income, a normal household's money, and they take the median qualifying amount to buy a home, a normal home, what they say is a median home. So essentially what we're doing is we're taking a normal family and what they make, and a normal home and what it costs, and we're saying how likely is it that these two match up. What NAR does is they go a step further, and they also do it by region. And we've recently seen in the data that it's very interesting and clear that there's one region in America that's beating everybody else, and there's two regions in America that if you're trying to buy there, you are up a creek with this. Not even without a paddle. You're given a pencil, a lead pencil without an eraser, and told, go up this creek, go up these white rapids of the housing market. The two that are extremely expensive, as you'll see on the screen right now, are the Northeast and the West. The Northeast currently has such a higher median needed income to buy the normal median home that the Housing Affordability Index is below 100. This is also true with the West. The West is even worse. The West and the Northeast are both awful in terms of what people make in that area, normally over 100K, but we're talking about needing to make, to qualify for the home, 120 plus, 130 in some areas. There are some areas in California where the median home is $850,000. Again, up a creek with one of these. Now, where could you potentially, and this is where we get radical, move, relocate, go to actually be able to afford a home? It's going to be the Midwest. Yeah, I am talking about Arkansas, Texas, Joplin, Missouri, the Ozarks. I am talking about those areas because right now, if you look at what the median income of those areas is, you're still looking at nearly $100,000 per household, but the qualifying income is about 25 grand less, meaning the median home is making enough to buy a median home. That's the number I want to see. And that puts their housing affordability index well above 120. It's an insanely affordable area. Now some would say, hey, look, I want to be 45 minutes at minimum from a Target. That's normal. Maybe you're more of a Costco. But either way, you want to be close to society. You may have a couple little nuances to go through logistically of where would your job be and how close are we to a community that actually has stores, and can I find this new construction townhome? You just said they don't build them in random parts in Oklahoma. Yes, which is why all three of these together, you're looking for the diamond in the rough. You're looking in an area that's affordable for the perfect type of home from the perfect source with the perfect mortgage. And that's what I'm trying to line up for you because today's market stinks. It's unaffordable. Historically, the last 3 years, no drama. And I'm not a dramatic person ever. No drama. It is the most unaffordable housing market to ever enter into. Wages are stagnant. Money isn't flowing from the working class. And builders aren't building affordable housing. I just mentioned tiny homes earlier. I would love if we had tiny home neighborhoods. I would love if we started to institutionalize, industrialize the building of container homes. Start building hut homes. Start building them underground. Like start building something different. In rural areas like Delaware, start building up. We don't build up. We're always looking to build horizontally and we're like, oh, we got a farm. We can't do the farm. Okay, let's take this residential area over here. Instead of there being one home, let's have 16 that go up. Let's build something of starter variety for the next generation. We're not seeing that, and instead of complaining about it, let's try to be a part of the change, which we are here over at Loft, and myself over on TikTok. I'm talking about this very often, about how we need change in this environment. We need builders to build. We need incentivization for them to. But ultimately, we have to adapt. We can't just sit in the dirty diaper and whine about it. Things are where they are for a reason, corrupt or not. You can have your opinions, but I also believe they're not going away. Potentially, like I said earlier, could get worse. Home prices more than likely double, then they do crash. So what I want you to do is be an investor, not a consumer. Invest in yourself, not just in your finances, by the way. Invest in your finances and don't consume your finances, but invest in your body. Invest in your brain. Invest in whatever book of religion you follow. Invest in your marriage. Go on date night. That's what I'm talking about, invest versus consumption. That $50 you're not consuming with could be the $50 you invest into date night for your wedding, for your marriage. Could be the $60 you spend to take your kid to the fair. I know that must be a very expensive fair, but regardless, you get what I'm saying. Invest in who you are and who you want to be in 2030, which I hope one of those things is owning a home, and don't just consume it away. I know it's so tempting to, but don't. So let's rerun through this, and I got some final takes at the end for those that want to listen along. So we walk through the 4 main qualifiers. So we have to hit DESC, DESC. That's income, employment, savings, and credit score. I walk through where they need to be, the truths of today, and where we source them from. Like, for example, Credit Karma's a no. Hitting up a mortgage lender to get free credit repair is a yes. Going into a mortgage lender and saying, I want a conventional loan with 20% down because that's what my grandpappy said I need to do. No. FHA, 3.5%. I'll even throw out another one here at the end. That's 100% financing, but you may not qualify for it. We walk through the progress. We need to increase our income. We need to increase our credit, and we need to stock up while cutting debt. Those are the big 3. And I know I said 4 originally, but the last 2 are pretty much the same. I would hate for you to cut debt just to go find more debt with your extra money. That would be pretty silly. Don't do that. And of course, the payoff being, where's the best mortgage available? Where's the best home? And where do I potentially need to move to? I know that's crazy. You think new job, relocation. This guy's asked me to change my whole life. You may have to if you want to be a homeowner, because if you're in Manhattan, it ain't happening. I just thought of that. If you're in Manhattan, it's not happening. You can't do that. If you're making 60 grand, not possible. Not even conceivable in the entire market, nevertheless expensive markets. The Northeast, the West Coast, areas like even in the South, Dallas, Atlanta, you get in areas where it is also very expensive down there. You got to get somewhere you can afford, and I got to give you one positive of all of this. If you're in an area where you are potentially digitally available or you work virtually and you make 80 grand, but you're in like a 120 grand needed area, move. Like, move. You don't have to be where you're at, move. I can't express that enough, how relocation might be something you have to think a little bit. Not saying you have to. Don't say some guy on YouTube told me to move and that's why I'm moving, mom and dad. But to think about. Now, to finish this off, I do want to say, if you're looking in Delaware, I would love to serve you. If you're looking anywhere in the country and you're looking for a trusted agent, I have a list and I can provide that list for you. Just hit me up. Here's my number, 302-503-6647. Say, Zach, I need a realtor in blank. I'll help you. Buy, sell, invest. The other one is there's also another 100% variety program. It's called USDA. If you're in Delaware, about 60% of Delaware actually qualifies for this, and I'm going to give you a site you can go to here in a moment. But if you go into USDA, you get 100% financing, but it has to be in a rural area. Rural, meaning you're probably close to a farm, not highly populated, but this is what some people really want. And they do 100% financing so long as you don't make too much. And the cool thing about USDA, just like VA and FHA, it's government. They're the same people that grade our beef. It's weird. You could also double dip the chip with the state authority with USDA, so you can get 100% financing and money or a lower rate. It's a cool one. Okay, I want you to buy a home by 2030. I think there's no better way to survive the asset inflation that will continue to perpetuate in our economy than by holding on to a piece of real estate. Having a piece of dirt to your name has been the American dream, or at least a big part of it, for decades, and there's been no harder time to do it than right now. We know that over the last decades, it's only become more and more difficult, and here I am going to predict that it's probably going to continue to get more difficult. So start now. Invest in yourself, stop consuming yourself, and understand wherever we're at in the economy in 5 years, whether we've crashed, good. You saved money and got your credit up, you're gonna get a good deal. Whether it went up, good. You got your savings up, you got your credit up, and you got your income up, and maybe you move to an area that's more affordable, and you're ready. Or things stay moderately the same, and you're just, again, over-prepared. Whatever result happens, I want you prepped for it, and the best way to prep for it is getting your credit up, income up, and investing in yourself on a daily basis. So hopefully you can be a homeowner by 2030. And before we finish, subscribe if you haven't already. It helps the algorithm. Hit the like button, leave a comment saying, hey, you look sweaty, whatever works. Appreciate you.